The analysis of financial data employs various techniques to emphasize the comparative and relative importance of the data presented and to evaluate the position of the firm. These techniques include ratio analysis, common size analysis, study of differences in components of financial statements among industries, review of descriptive material, and comparisons of results with other types of data. The information derived from these types of analysis should be blended to determine the overall financial position. No one type of analysis supports overall findings or serves all types of users. This chapter provides an introduction to different analyses and uses of financial information. Financial statement analysis is a judgmental process. One of the primary objectives is identification of major changes, turning points, in trends, amounts, and relationships and investigation of the reasons underlying those changes. Often, a turning point may signal an early warning of a significant shift in the future success or failure of the business. The judgment process can be improved by experience and by use of analytical tools. Financial ratios are usually expressed as a percent or as times per period. The following ratios will be discussed fully in future chapters. Liquidity ratios measure a firm's ability to meet its current obligations. They may include ratios that measure the efficiency of the use of current assets and current liabilities, Chapter 6. Borrowing capacity, leverage, ratios measure the degree of protection of suppliers of long-term funds, Chapter 7. Profitability ratios measure the earning ability of a firm. Discussion will include measures of the use of assets in general, Chapter 8. Investors are interested in a special group of ratios, in addition to liquidity, debt, and profitability ratios, Chapter 9. Cash flow ratios can indicate liquidity, borrowing capacity, or profitability, Chapter 10. A ratio can be computed from any pair of numbers. Given the large quantity of variables included in financial statements, a very long list of meaningful ratios can be derived. A standard list of ratios or standard computation of them does not exist. Each author and source on financial analysis uses a different list and often a different computation of the same ratio. This book presents frequently utilized and discussed ratios. Ratios are interpretable in comparison with 1. Prior ratios, 2. Ratios of competitors, 3. Industry ratios, and 4. Predetermined standards. The trend of a ratio and the variability of a ratio are important considerations. Comparison of income statement and balance sheet numbers, in the form of ratios, can create difficulties due to the timing of the financial statements. Specifically, the income statement covers the entire fiscal period, whereas the balance sheet applies to a single point in time, the end of the period. Ideally, then, to compare an income statement figure such as sales to a balance sheet figure such as receivables, we need to know the average receivables for the year that the sales figure covers. However, these data are not available to the external analyst. In some cases, the analyst uses an average of the beginning and ending balance sheet figures. This approach smooths out changes from beginning to end, but it does not avoid problems due to seasonal and cyclical changes. It also does not reflect changes that occur unevenly throughout the year. Be aware that computing averages from two similar balance sheet dates can be misleading. It is possible that a representative average cannot be computed from externally published statements. A ratio will usually represent a fairly accurate trend, even when the ratio is distorted. If the ratio is distorted, then it does not represent a good absolute number. Applying the U.S. techniques of ratio analysis to statements prepared in other countries can be misleading. The ratio analysis must be understood in terms of the accounting principles used and the business practices and culture of the country. Common size analysis expresses comparisons in percentages. For example, if cash is $40,000 and total assets is $1 million, then cash represents 4% of total assets. The use of percentages is usually preferable to the use of absolute amounts. An illustration will make this clear. If firm A earns $10,000 and firm B earns $1,000, which is more profitable? Firm A is probably your response. However, the total owner's equity of A is $1 million and B's is $10,000. The return on owner's equity is as follows. The use of common size analysis makes comparisons of firms of different sizes much more meaningful. Care must be exercised in the use of common size analysis with small absolute amounts because a small change in amount can result in a very substantial percentage change. For example, if profits last year amounted to $100 and increased this year to $500, this would be an increase of only $400 in profits, but it would represent a substantial percentage increase. Vertical analysis compares each amount with a base amount within a base amount, commonly sales for the same year. For example, if advertising expenses were $1,000 in 2011 and sales were $100,000, the advertising would have been 1% of sales. Horizontal analysis compares each amount with a base amount from a selected base year. For example, if sales were $400,000 in 2010 and $600,000 in 2011, then sales increased 150% of the 2010 level in 2011, an increase of 50%. Exhibit 5:1 illustration of common size analysis include vertical and horizontal, from the textbook, page 201. Comparing financial statements over two time periods using absolute amounts and percentages can be meaningful. This approach aids in keeping absolute and percentage changes in perspective. For example, a substantial percentage change may not be relevant because of an immaterial absolute change. When performing year-to-year change analysis, follow these rules. When an item has value in the base year and none in the next period, the decrease is 100%. A meaningful percent change cannot be computed when one number is positive and the other number is negative. No percent change is computable when there is no figure for the base year. Exhibit 5:2 year-to-year change analysis, from the textbook, page 202. The components of financial statements, especially the balance sheet and the income statement, will vary by type of industry. Exhibits 5:3, 5:4, and 5:5 illustrate, respectively, a merchandising firm, Best Buy Company, Inc., a service firm, Kelly Services Incorporated, and subsidiaries, and a manufacturing firm, Cooper Tire and Rubber Company. Exhibit 5-3, 5-4, 5-5, from the textbook, page 202-205. Merchandising, retail wholesale, firms sell products purchased from other firms. A principal asset is inventory, which consists of merchandise inventories. For some merchandising firms, a large amount of sales may be for cash. In such cases, the receivables balance will be relatively low. Other merchandising firms have a large amount of sales charged but also accept credit cards such as Visa, so they also have a relatively low balance in receivables. Other firms extend credit and carry the accounts receivable and thus have a relatively large receivables balance. Because of the competitive nature of the industry, profit ratios on the income statement are often quite low, with the cost of sales and operating expenses constituting a large portion of expenses. Refer to Exhibit 5-3, Best Buy Company, Inc. A service firm generates its revenue from the service provided. Because service cannot typically be stored, inventory is low or non-existent. In people-intensive services, such as advertising, investment in property and equipment is also low compared with that of manufacturing firms. Refer to Exhibit 5-4, Kelly Services Incorporated, and subsidiaries. A manufacturing firm will usually have large inventories composed of raw materials, work in process, and finished goods, as well as a material investment in property, plant, and equipment. Notes and accounts receivable may also be material, depending on the terms of sale. The cost of sales often represents the major expense. Refer to Exhibit 5-5, Cooper Tire and Rubber Company. The descriptive information found in an annual report, in trade periodicals, and in industry reviews helps us understand the financial position of a firm. Descriptive material might discuss the role of research and development in producing future sales, present data on capacity expansion and the goals related thereto, discuss aspects of employee relations such as minority hiring or union negotiations, or help explain the dividend policy of the firm. In its annual report, a company must present a section called Management Discussion and Analysis (MD&A). This section provides an overview of the previous year and of future goals and new projects. Although the MD&A is unaudited, the information it contains can be very useful. Absolute figures or ratios appear meaningless unless compared to other figures or ratios. If a person were asked if $10 is a lot of money, the frame of reference would determine the answer. To a small child, still in awe of a quarter, $10 is a lot. To a millionaire, $10 is nothing. Similarly, having 60% of total assets composed of buildings and equipment would be normal for some firms but disastrous for others. One must have a guide to determine the meaning of the ratios and other measures. Several types of comparisons offer insight. Trend analysis studies the financial history of a firm for comparison. By looking at the trend of a particular ratio, one sees whether that ratio is falling, rising, or remaining relatively constant. This helps detect problems or observe good management. The Standard Industrial Classification is a statistical classification of business by industry. The National Technical Information Service publishes the classification manual. The manual is the responsibility of the Office of Management and Budget, which is under the Executive Office of the President. Use of the SIC promotes comparability of various facets of the U.S. economy and defines industries in accordance with the composition and structure of the economy. An organization's SIC consists of a 2-digit major group number, a 3-digit industry group number, and a 4-digit industry number. These numbers describe the business's identifiable level of industrial detail. Determining a company's SIC is a good starting point in researching a company, an industry, or a product. Many library sources use the SIC number as a method of classification. The U.S. Department of Labor provides a website that details the SIC manual and provides for searching via keywords. The North American Industry Classification System, NAICS, was created jointly by the United States, Canada, and Mexico. It is to replace the existing classification of each country, the Standard Industrial Classification of Canada, 1980, the Mexican Classification of Activities and Products, 1994, and the Standard Industrial Classification, SIC, of the United States, 1987. The United States adopted the NAICS in 1997 for statistical agencies. Most of the U.S. government agencies now use the NAICS in place of the Standard Industrial Classification. A major exception is the Securities and Exchange Commission, SEC. Companies reporting to the SEC include their SIC. For private companies that publish industry data, some now only use the NAICS, others use the SIC, and still others include both the NAICS and the SIC. The U.S. Census Bureau provides a website that details the NAICS manual and provides for searching via keywords. To get to this site, open www.census.gov and choose under Business and Industry, click on NAICS. The analysis of an entity's financial statements is more meaningful if the results are compared with industry averages and with results of competitors. Several services provide composite data on various industries. The analyst faces a problem when the industries reported do not clearly include the company being examined because the company is diversified into many industrial areas. Since many companies do not clearly fit into any one industry, it is often necessary to select the industry that best fits the firm. The financial services lists industries and suggests in which industry to place a company. Thus, a financial service listing is sometimes used to identify the industry the firm best fits. This section briefly describes some financial services. For a more extensive explanation, consult the services literature. Each service explains how it computes its ratios and the data it provides. On pages 209 to 212 of the textbook, there are many related reports and survey. As indicated previously, comparison has become more difficult in recent years as more firms become conglomerates and diversify into many product lines. To counteract this problem, the SEC has implemented line of business reporting requirements for companies that must submit their reports to the SEC. These reports are made available to the public. SFAS number 14 also addresses line of business reporting requirements. Such reporting requirements ease the analysis problem created by conglomerates but cannot eliminate it because the entity must decide how to allocate administrative and joint costs. If industry figures are unavailable or if comparison with a competitor is desired, another firm's statements may be analyzed. Remember, however, that the other firm is not necessarily good or bad, nor does it represent a norm or standard for its industry. It also can be said that industry figures do not necessarily represent good or bad, nor do they represent a standard for its industry. Alternative accounting methods are acceptable in many situations. Since identical companies may use different valuation or expense methods, it is important to read statements and notes carefully to determine whether the statements are reasonably comparable. Ideally, the use of all types of comparison would be best. Using trend analysis, industry averages, and comparisons with a major competitor will give support to findings and will provide a concrete basis for analysis. In analyzing ratios, the analyst will sometimes encounter negative profit figures. Analysis of ratios that have negative numerators or denominators is meaningless, and the negative sign of the ratio should simply be noted. Financial analysis requires judgment decisions on the part of the analyst. Users of financial statements must be careful not to place undue confidence in ratios or comparisons. Remember that ratios are simply fractions with a numerator, top, and a denominator, bottom. There are as many ratios for financial analysis as there are pairs of figures. There is no set group, nor is a particular ratio always computed using the same figures. Even the industry ratio formulas vary from source to source. Adequate detailed disclosure of how the industry ratios are computed is often lacking. Major problems can result from analyzing a firm according to the recommendations of a book and then making comparisons to industry ratios that may have been computed differently. The use of different accounting methods causes a problem. For example, identical firms may use different valuation or revenue recognition methods. Read statements and notes carefully to determine the degree of comparability between statements. Trend analysis within the same firm, however, will usually be meaningful. Industry averages group firms together that use different accounting principles. Different year-ends can also produce different results. Consider the difference in the inventory of two toy stores if one ends November 30th and the other ends December 31st. The ratios of firms with differing year-ends are all grouped together in industry averages. Firms with differing financial policies might be included in the same industry average. Possibly capital-intensive firms are grouped with labor-intensive firms. Different accounting methods. Large amounts of debt may be included in the same average as firms that prefer no debt financing. Industry averages often represent averages from small samples that are not representative of the industry. An extreme statement, such as one containing a large loss, can also distort industry averages. Ratios may have alternative forms of computation. In comparing one year to the next, one firm to another, or a company to its industry, meaningful analysis requires that the ratios be computed using the same formula. For example, annual statement studies computes income ratios before tax. Dun and Bradstreet profit figures are after tax. The analyst should compute the enterprise ratios on the same basis as is used for industry comparisons, but this is often not possible. Finally, ratios are not absolute norms. They are general guidelines to be combined with other methods in formulating an evaluation of the financial condition of a firm. Despite the problems with using ratios, they can be very informative if reasonably used. Comparisons of firms of different sizes may be more difficult than comparisons of firms of equal size. For example, larger firms often have access to wider and more sophisticated capital markets, can buy in large quantities, and service wider markets. Ratios and common size analysis help to eliminate some of the problems related to the use of absolute numbers. Be aware of the different sizes of firms under comparison. These differences can be seen by looking at relative sales, assets, or profit sizes. Investment services such as Value Line often make available another meaningful figure, percent of market. The typical business library has many sources of information relating to a particular company, industry, and product. Some of these sources are described here to aid you in your search for information about a company, its industry, and its products. More related services and resources are available on pages 213 to 215 of the textbook. The financial statements are prepared for a group of diversified users. Users of financial data have their own objectives in analysis. Management, an obvious user of financial data, must analyze the data from the viewpoints of both investors and creditors. Management must be concerned about the current positions of the entity to meet its obligations, as well as the future earning prospects of the firm. Management is interested in the financial structure of the entity in order to determine a proper mix of short-term debt, long-term debt, and equity from owners. Also, management is interested in the combination of cash, inventory, receivables, investments, and fixed assets. Management must guide the entity towards sound short and long-term financial positions. For example, liquidity and profitability are generally considered important. It does not help to have highly liquid assets, cash and marketable securities, at an excessively high level. It also does the entity little good to be guided toward a maximum profitability position with poor liquidity. The entity would soon find itself in bankruptcy as unable to meet current obligations. The investing public, another category of users, is interested in specific types of analysis. Investors are concerned with the financial position of the entity and its ability to earn future profits. The investor uses an analysis of past trends and the current position of the entity to project the future prospects of the entity. Credit grantors are interested in the financial statements of the entity. Pure credit grantors obtain a limited return from extending credit, a fixed rate of interest, as in the case of banks, or the profit on the merchandise or services provided, as in the case of suppliers. Since these rewards are limited and the possibility exists that the principal will not be repaid, credit grantors tend to be conservative in extending credit. The same principle applies to suppliers that extend credit. If merchandise with a 20% markup is sold on credit, it takes 5 successful sales of the same amount to make up for 1 sale not collected. In addition, the creditor considers the cost of the funds when extending credit. Extending credit really amounts to financing the entity. A difference exists between the objectives of short-term grantors of credit and those of long-term grantors. The short-term creditor can look primarily to current resources that appear on the financial statements in order to determine if credit should be extended. Long-term creditors must usually look to the future prospects of earnings in order to be repaid. For example, if bonds are issued that are to be repaid in 30 years, the current resources of the entity will not be an indication of its ability to meet this obligation. The repayment of this obligation will come from future earnings. Thus, the objectives of financial analysis by credit grantors will vary, based on such factors as the term of the credit and the purpose. Profitability of the entity may not be a major consideration, as long as the resources for repayment can be projected. The financial structure of the entity is of interest to creditors because the amount of equity capital in relation to debt indicates the risk that the owners bear in relation to the creditors. The equity capital provides creditors with a cushion against loss. When this equity cushion is small, creditors are bearing the risk of the entity. Many other parties are interested in analyzing financial statements. Unions that represent employees are interested in the ability of the entity to grant wage increases and fringe benefits, such as pension plans. The government also has an interest in analyzing financial statements for tax purposes and for ensuring compliance with antitrust laws. Financial analysis consists of the quantitative and qualitative aspects of measuring the relative financial position among firms and industries. Analysis can be done in different ways, depending on the type of firm or industry and the specific needs of the user. Financial statements will vary by size of firm and among industries. The SIC and NAICS classification systems have been developed to promote comparability of firms. Determining a company's SIC and/or NAICS is a good starting point in researching a company, an industry, or a product. The analysis of an entity's financial statements is more meaningful if the results are compared with industry averages and with results of competitors. At the same time, caution must be exercised in using industry averages and results of competitors. Many library services are available that relate to individual companies, industries, and products. These sources can be a valuable aid in researching a firm. Financial statements are prepared for a group of diversified users. These users have various needs and uses for the financial statements.